Welcome to the FedLife Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife Podcast. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe & Associates. I always get excited about doing these podcasts. This is a new level because it's a new year. It's a new decade. I know you're not supposed to do that in podcast world because you're supposed to be able to listen to this anytime, but I'm still excited. But before I get to that, I want to say thank you for taking the time to listen. And as I always say, thank you for your service. You simply do not hear that enough. So among the reasons why I'm super excited, besides new year, new decade, here's a FedLife riddle. What happens every 4 years that gets people talking about things that they never talk about any other time and sometimes start going crazy and yelling? And if you guessed elections, you would be wrong. It's the Olympics. This is an Olympic year. You'll hear more about that as we go through this. If you listen to my inaugural podcast, you know I am an unabashed Olympics fan and a track and field geek. So we'll have some surprises going along, just some fun stuff where that's concerned. So we are back again today with the incomparable Ed Zurndorfer, the guru, as part of our ongoing mission to reach, teach, and serve you. And at the outset, as I always do, I need to say, the opinions of our guest, Ed Zurndorfer, are not necessarily the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only, not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. Okay, Ed, Happy New Year and welcome.
Thanks, Dan. Happy New Year to you.
And I'm going to throw this out there. This will make sense in a minute. We're going to throw an important number around a lot today. It's 8606. We'll be coming back to that. Once again, we are mirroring Ed's FedZone articles, covering his reminder to all our feds that they still have time to contribute to an IRA for the year. And when you're sitting there going, I can't, you need to listen to this podcast because Ed may teach you a few things where you go, I didn't know that. And I would also like to point out another reason for you to be super excited that Ed will now be featured in the FedZone every week. That's right, twice the Ed in 2020. Not one, not two, not three, but 4 articles every month for you folks to read. Ed's stuff is always awesome. And that's in the FedZone at stwserve.com or at blog.stwserve.com. And the reason why, I've been working with Ed for a while now, and I can say with absolute certainty that our combined mission is to provide you, the dedicated men and women, federal workforce, with the information and the education that you'll be empowered to make the best decisions you can to bring about the best life that you can have in retirement. Right, Ed?
Can't say it enough. And knowledge is power.
There we go. And as always, if you're listening on your commute and cannot write something down, no worries. The complete article is on our website, again, at blog.stwserve.com. So let's jump in. In article number 1, Ed, you sort of go into the basics. And I think sometimes when people, get a job that has a TSP or a 401k or a pension, they just forget about IRAs altogether.
That's right, Dan. And unfortunately, there's a lot of misinformation among federal employees about IRAs. I've heard this. They say to me, Ed, because I put money into the TSP, I'm covered by FERS, I'm covered by CSRS, I'm not allowed to contribute to an IRA. Dan, nothing can be further from the truth.
And we'll be tackling that today. So as your article starts, you start with the contribution dates and then talk about the different types of IRAs. So let's start with those dates because it's not calendar year end. So if we're talking in January and somebody didn't do it in December, they're not necessarily out of luck.
That's right, Dan. And I just want to mention that for calendar year 2019, the requirement to contribute to an IRA for calendar year 2019 is that you had to have earned income, salary, wages, and or your spouse did. So if you are married, you're a federal employee, and you have a stay-at-home dad, stay-at-home mom or dad, your stay-at-home dad or mom who was not getting paid this year, per se, would be allowed to contribute to his or her own IRA. And the deadline for contributing for 2019 is tax filing deadline date of April 15, 2020. You have until April 15, 2020 to make your 2019 IRA contribution.
Okay, so there's still some time there. Now, Ed, do extensions impact that? Because I know people do that from time to time.
Dan, unfortunately, if you file for an extension, your deadline is still April 15th to make your 2019 contribution.
Okay, good. Okay. I'm glad I asked. Okay, so now why don't you briefly touch on the three types of IRAs that you cover in the article? So let's dig right in with the granddaddy of them all, as I guess starting back in the 70s, the traditional IRA.
Yes, as you pointed out, Dan, in the 70s, the traditional IRA was born 1974 as part of the creation ERISA Act. In 1974 was created. At that time, there was only one type of IRA, traditional IRA. You could put in a maximum $1,200, believe it or not, anybody who had earned income. And the contribution that you made, the $1,200 that went to the traditional IRA, resulted in a $1,200 deduction from your income for tax purposes. It was an adjustment, and it still is an adjustment to your income, a contribution to a deductible traditional IRA.
Okay. And second would be the Roth IRA.
The Roth IRA was created in 1998, in which an individual can contribute to an IRA if they have a Roth IRA, if they have earned income, and so could their spouse. The contribution would not be deductible, but the earnings received within the IRA would not be taxed, as well as the contributions, because the contribution was taxed beforehand. If that money was pulled out, what's called a qualified Roth IRA distribution. Backing up to the traditional IRA contribution that was made, it got also earnings that grew tax deferred, but everything coming out of the traditional IRA was taxed entirely when it was withdrawn.
Right. Fully taxable. Yep.
Fully taxable, both federal and state, for federal and state tax purposes.
Okay. And with the Roth, since you're going in with money you're already taxed on, then if you follow the rules, take it out the right way, you're not going to pay taxes.
Exactly.
Okay. Last one, many folks might not know that much about, and that's the Coverdell Educational Savings Account. Tell us a little about that one.
Yes, Dan. Congress created what's called an educational IRA. They were first called educational IRAs, in which an individual could contribute $2,000 to this. It was $500, and I think until 1998, they raised it to $2,000, in which the money going in, again, would not be deductible, but the money would grow tax deferred, provided that the money pulled out would be used for some type of educational expenses. When I say educational expenses, I don't mean necessarily college. I mean, it could be nursery school, it could be day school tuition, it could be for high school tuition, middle school tuition, as long as it's for some type of education. It could be used to buy school supplies, things like that. And the money would be put in for the benefit of a child who was younger than age 18. When a child turns 18, the money and no more money could be contributed to that child's educational IRA. Now it's known as the Coverdell Educational Savings Account, CESA. And the reason it's called that is because the late Paul Coverdell, senator from Georgia, was one who created it.
Okay. All right. Well, late Senator Coverdell, my apologies for mispronouncing the name. Now, there are some income limits that can affect a person's ability to participate in these options. So let's talk those through. Let's again start with the granddaddy here with the traditional IRA.
With the traditional IRA, Dan, between 1974 and 1986, all contributions made to traditional IRAs were deductible. Then in 1986, Congress passed what's called the Tax Simplification Act of 1986. In which they changed among other things, they changed the rules for IRAs. And here's what the rule said: that if an individual is covered by a pension plan, a retirement plan, participates in a retirement plan, and their income is too high, then while they are allowed to contribute to a traditional IRA, their contribution may not be deductible. Depends on what their what's called their modified adjusted gross income is for that year. If their income is above a certain amount, then the contribution would not be deductible. If they're below the lower limit, then the contribution would be, and if they're in between the two limits, that the upper and the lower limit, then they could deduct some, but not all of their contribution to the IRA. Now, this has caused some confusion because the question is, how do I know I'm covered by a pension plan? Okay.
Gotcha.
How would I know that? Well, you would know that by looking at your W-2. When you get your W-2, federal employees get their W-2 like other employees in January.
Mm-hmm.
And there is a box on that W-2. I believe it's box number 13 that says retirement plan.
Gotcha.
Retirement plan. If you're covered by a retirement plan, that box will be X'd. That tells you that you are covered by a retirement plan. I do want to say this. Some individuals who do work in private industry do not have what's called a defined benefit plan. They participate in a 401k plan or a 403b plan.
Mm-hmm.
They put money into the plan, and in some cases, they do not get matching from the employer.
Mm-hmm.
If the employee put money into that pension, that 401k plan, 403b plan, then the box number 13 will be X. But for some reason, let's say the employee had a bad year, could not afford to contribute to the 401k, did not contribute to the 401k, the employer put nothing in, then that box will not be X'd out, which means they're not covered that year with a pension plan.
Okay.
But all federal employees are covered by a pension plan because they are contributing either to CSRS or FERS.
Gotcha.
And in the case of FERS employees, they're definitely putting money into the TSP. So that you know for sure that box number 13 on a federal employee's W-2 will be X'd out.
Okay. Now, you also noted some of the rules for spousal IRA. Let's talk about that a little bit because I think people miss some opportunities there.
Yes. When it comes to a spousal IRA, again, it only takes, in case of a married couple, one spouse's earned income to make both spouses eligible to contribute to into an IRA. If one spouse is working, the other spouse is a stay-at-home dad or mom, the stay-at-home mom or dad. Mm-hmm. In that case, then if the working spouse puts in a certain amount, then the non-working spouse can also contribute up to the limit to the IRA for that year.
Okay,
it takes care. But I just want to mention that the limits for contributing to an IRA, there are contribution limits every year. For example, 2019, the limit for contributing to a traditional IRA or a Roth IRA or both, you can, because you actually could contribute to both.
Sure.
If you're eligible. If you're under 50 as of December 31st, 2019, you can put a maximum $6,000 into the IRA. Mm-hmm. If you're over 50, $7,000.
So you get the catch up.
So because there's a $1,000 so-called catch up. If one spouse, let's say, is putting in $6,000 or $7,000, the other spouse can. However, if let's say for some reason one spouse is earning less than $7,000, one spouse is working or earning less than $7,000.
Gotcha.
Then the limit for contributing is actually the amount of their earned income.
Which makes sense.
If they're only earning $5,000, then each spouse can only put in $5,000.
Okay.
It's the lower of the two amounts.
So we're in this case, we're talking about, generally speaking, deductible IRAs. So let's talk a little bit about, because you touched on it before, let's go into a little more depth. So you put the money away over the years, it's grown. Now you're going to take it out. It's like you earned it that year, right?
In what sense?
As far as it's taxed.
As far as taxes, it's taxed at the rate you are at that year. Year. I do want to say, in the case of a traditional IRA, that in order to take it out penalty free, no 10% over withdrawal penalty, you have to be over 59.5. There are some exceptions.
Gotcha.
For example, you could take the money out of a traditional IRA, pay the tax, but no penalty to buy your first home. Mm-hmm. You could use it to pay for educational expenses. There's a certain limit for spouses, for children. Okay, so there are some exceptions for not paying the penalty if you take it out over 59.5. But in general, if you don't want to pay penalty, you got to be over 59.5 to take the money out.
Gotcha.
As far as a traditional IRA, that is a fully deductible traditional IRA. When it comes to the non-deductible traditional
excellent
IRA,
segue. That's where I was going next.
It works a little bit different, Dan, because when you contribute to a non-deductible traditional IRA, let's say you are not eligible to contribute to a deductible IRA. Here we have a federal employee who is covered by a pension plan. And let's say their income this year, that is their adjusted gross income, is over, let's say is over $200,000. Okay. That employee cannot contribute to a deductible IRA because their income is too high.
Okay.
They could put in their $6,000 or $7,000 to a non-deductible traditional IRA. And then the $6,000, $7,000 they're putting in will not result in any instant tax savings for the current year, for 2019 in this case.
Gotcha.
They have to report to the IRS that the contribution they made was with after-tax dollars. And the way they do that is file IRS Form 8606.
See, folks, I told you that number would come back.
Any year in which you contribute to a non-deductible traditional IRA, you must file the Form 8606 to report your contribution. And what that Form 86 does, among other things, it establishes what is called a cost basis in your IRA. So that when you withdraw the contributions down the line, you're not going to pay tax again on that same money. You already paid tax on that money. You didn't need any tax benefits.
Gotcha.
And by the way, when you withdraw money from a non-deductible traditional IRA, you have to use the Form 8606.
There we go. It's
there
back
we go.
Again.
That form is very versatile.
Now, let me ask this, Ed. So a person decides to do this, they're down the road, they're taking it out. They're not going to be able to decide to take all their non-taxable part out first, are they?
That's right, Ben. They're going to have it's come out basically. It's going to come out pro rata.
Okay.
And for that reason, I just want to share some experiences I have with individuals. I have several clients who are over 70 and a half, and they are required to take money out of their traditional IRAs. And they've been putting money in traditional IRAs for years, ever since their late 70s, early 80s. So they come to me with their 1099-Rs from their IRA custodians, and it shows they took out, let's say, $15,000. That's the gross distribution.
Sure.
And in box 2 of the 1099-R, where it says taxable distribution, what does it have in there? Unknown.
Oh.
Which is an accountant's nightmare.
Ooh.
When you see the word unknown, because in my tax practice, they come across it all the time, it puts fear in your stomach because it's going to force you to ask the question to the client.
Did you file an 8606?
And you're afraid of the answers.
Which might be no.
Which is, I don't know what you're talking about. I said, look, can I look at your past tax returns? So the client says, I never filed the Form 8606. I have no record of it. Okay. Or my accountant never told me I had to do it.
Ouch.
So which means that I, as your accountant now, have to assume, since it was never filed, then we're going to have to assume it's all taxable then. Now, there is a way out of this, though.
Okay.
Because the Form 8606 can be submitted by itself for any year you made a non-deductible traditional IRA contribution. By itself, this way it tells the IRS that money was already taxed, so it won't be taxed when it's taken out. It can be filed by itself. Okay. IRS on its website, www.irs.gov, for Form 86, has all the 8606 forms going back to 1987 when they started.
Gotcha.
So let's say in 1992, you forgot to report that $2,000 non-deductible traditional IRA contribution. You just download the Form 8606 for 1992, put in $2,000 on that form as your contribution, submit to IRS, and now you have a cost basis of $2,000.
Okay.
Now, there might be a $50 penalty, but it's a lot cheaper than paying tax on that.
Okay, important tip, everybody. 8606 might be your friend here. And as always, and Ed stressed it very well here, record keeping is super important here. So next up is the Roth. And here I want to stress, Roth IRA rules and Roth TSP rules are different. We covered that in FedLife Podcast number 12. You can find that on our FedLife YouTube channel, as well as on our website, scwserve.com. Look for the tab that says blogs and podcasts, because it's an important distinction. Because if you go back to that one, you're going to hear Ed and I swap stories about talking to feds, and they go, oh, I can't put money in Roth TSP because I make too much money, which is incorrect on that note. But we're not going to take time for that now. But just remember, the rules are different. And so the Roth IRA rules are?
Okay, let's review the Roth IRA rules. Now, Roth IRA rules only have one rule, and that is, again, you have to have earned income. You got to earn income. But if your income is too high,
gotcha,
you are not allowed to contribute to a Roth IRA.
Gotcha.
If your income is too high. I want to emphasize, Bob, this is different entirely than the Roth TSP. The Roth TSP has no income limitations like the Roth IRA does. Okay. So in that column, I think it's my third column for the month of January, I talk about the income limits for Roth IRAs.
You do indeed.
So there's no age limit. You could be over 70 and a half, or maybe you're married. Maybe you're over 70 and a half, not working, but you're married to a younger spouse who's working. You'd be allowed to contribute to a Roth IRA provided that your income, your modified adjusted gross income, basically your adjusted gross income, is below that amount as specified in the tables provided in that column.
Gotcha.
Okay? So that's the only restriction is income.
Got
it. Let me just mention one other thing about traditional IRA because the rules are going to change. As far as contributing to a non-deductible traditional IRA, there are no income limitations for contributing to a traditional IRA. The only restriction is age. If
Gotcha.
you're over 70, you're not allowed to contribute to a traditional IRA, even if you have earned income. That's for 2019. As a result of the passage of the Secure Act,
coming attractions,
which is, as Dan said, coming attraction. We're going to talk about it. One of the provisions of the Secure Act is the fact that Congress removed the age restrictions for contributing to traditional IRAs. Just like there are no age restrictions for contributing to a Roth IRA, there are no age restrictions for contributing to a traditional IRA effective January 1st, 2020. I want to emphasize the new rules do not apply for 2019 traditional IRA contributions.
And folks, don't worry. I've already seen the advance work for Ed's articles for February. We're going to be covering the Secure Act, and we're going to be diving deep into it for the podcast. If we have to do a couple of them so that everybody has what they need, we'll make sure you get that. On the Roth, just let's touch on it again. Tax treatment of distributions. I put my money in after tax. I followed all the rules. I stayed within income limits. I'm ready to take it out. What do I have?
One thing we got to keep in mind about Roth IRA distributions, yes, they are tax-free, provided that it is a qualified Roth IRA distribution. And people are wondering, what is a qualified Roth IRA distribution?
What is a qualified Roth IRA distribution?
In order to make a qualified Roth IRA distribution, the Roth IRA owner has to fulfill two requirements. One, it has to be at least 5 years since January 1st of the year they made their first Roth IRA contribution.
Gotcha.
Two, you must be over 59 and a half.
Okay.
59 and a half. Now, the Roth IRA started back in 1998. That was the first year. Let's say, Dan, there's an individual who made a Roth IRA contribution, the first one in 2000, the year 2000. And they made another one in 2005, another one in 2013, a couple more since then. And now in 2020, they're turning 59 and a half years old, let's say this coming June. As of July 1st, they can start withdrawing all of their Roth IRA money and not pay tax on anything because it has been at least 5 years since they made their very first Roth IRA contribution, go back to 2000, and now they're past the age of 59 and a half.
Okay, so 5 and 59 and a half.
Also, Roth IRAs are not subject to required minimum distributions that traditional IRAs are. We're going to talk about that also, about the change of the rules on our next podcast, okay? But the Roth IRAs are not subject to required minimum distributions. Somebody could keep it in there indefinitely. This is going to be very useful as far as the Roth TSP is concerned. I say that because the Roth TSP is subject to required minimum
Yes, it is.
distribution. So a good strategy for a federal employee who has a Roth TSP account is that they transfer, and they could directly transfer their Roth TSP to a Roth IRA, and they do that before, let's say, 70 or new rules 72. And in so doing, they will not have to take a required minimum distribution from the Roth TSP because it's no longer there. It's inside the Roth IRA.
Sure. Makes sense. And lastly, let's not forget Coverdale.
Coverdales I find to be very helpful for some people paying for, let's say, day school tuitions for their kids. It's not going to buy a lot of college, $2,000 a year.
Sure.
We can talk more about the 529 plans at a later podcast, but it's there. I think that it's very interesting that the maximum $2,000 you can put in. There are income restrictions as far as putting money into a Coverdale. The $2,000 you can't be above, I think, $205,000 or something like that. But to be honest with you, Dan, I don't think that's going to be a problem because what I've advised clients, they say I can't put the money into that Coverdale for my grandchild because I'm over $200,000. It's very simple. Why don't you just gift the $2,000 to your son or daughter?
There you go,
and or daughter-in-law, and then they'll put it in, for your half. So that's also the way done.
I think it's interesting that contributions don't count against the IRA limits.
They're for different purposes.
Sure.
Coverdales are to pay for educational expenses, and IRAs are to pay for educational expenses. Just like HSA contribute. When you put money into a health savings account, which we've talked about, that's used to pay for medical expenses.
Sure.
That doesn't count against the IRA contribution.
And you follow the rules, you take the money out of the Coverdale. What are they looking at there? No taxes?
Once again, no taxes provided. It's used to pay for qualified educational expenses, tuition, books, fees, things like that.
Okay. All right. And to start rounding through that first article, because it's pretty expansive, you had some bullet points that I thought were really, really good. So let me buzz through those quickly. This is for individuals, IRAs, including traditional and Roth. It can provide some or all of the following features or benefits: convenient depository and a disciplined method for annual savings, annual deduction for some employees, depending on income. In the case of traditional IRA contributions, a way to achieve tax-deferred growth on assets, definitely. It then can become a supplemental source of retirement income, source of emergency funds, source of funds for higher education, because you mentioned you can take it out for that source of funds for a first home. A vehicle for pursuing several investment options. That's a great point, Ed, because if you're a Fed with TSP, if you're a retired Fed working someplace else, now you've got a 401k, those things always have a menu. It doesn't matter. Even if it's a great menu, it's still a menu. And there are always other options outside that the people may want to take advantage of. A way to retain transferability. We'll talk about that in a minute because you do touch on that. An opportunity to maintain individual control over their retirement funds or other funds, again, give you some more flexibility. And an instrument for completing an individual's financial plan. I thought those were all really, really, really good bullet points and should help our listeners get some conversation that they can talk with their professional advisors, their tax advisors, that sort of thing. So that was really good. Now, you also caution about the penalties if we don't follow the rules. You're really good about that. Why don't you briefly cover those?
Here are the basic penalties when it comes to IRAs. First penalty, making an excess contribution.
Okay.
You put in more than you're allowed to. For example, 2019, you could put in maximum $6,000 to an IRA. I mean, you can have as many IRAs as you want. You could have 3 traditionals, you could have 3 Roths, and you could put in $1,000 to each for a total of $6,000. And you could have, and if you have 7 IRAs and you're over 50, you can put 1,000 into all 7. That's a total maximum of 7,000. But if you go above the 6,000, 7,000, IRS has what's called an excess contribution penalty, and that's equal to 6% of the excess.
Okay.
Excess. That's what's called excess contribution penalty. Next penalty, withdrawing your traditional IRA before 59.5, 10% early withdrawal penalty. Okay. When it comes to traditional IRAs, under current rules, for people, I should say, born before July 1st, 1949, who are going to be over 70.5 this year, they have to take money over 70.5 this year. And they have traditional IRAs. They have to take what's called required minimum distributions, RMDs. If you don't take out your RMD, the amount that you don't take out is subject to a 50% what's called excess accumulation penalty. IRS has some nasty penalties, and I advise people before they get get too involved in IRAs that they meet with their tax advisor to go over all the rules. Okay, over the rules. I do want to mention something about the Roth IRA, about the penalty. I met with a client last year, and he told me that put the allowed amount into a Roth IRA.
Gotcha.
Roth IRA, put in 6,000. He's under 50. And I said, "What's your income?" So he's a single person, and the limit for contributing to a Roth IRA last year was about 135,000.
Okay.
I asked him, "What was his income last year?" He told me 156,000. So he was above it. So I said, "You got to get that. You got to do," and we're going to talk about this in a few moments.
Yep.
We characterize the contributions. Nah, I'm not just going to leave it in there. I'll take my chances. I said, well, I can't meet with you anymore if you're going to take that type of attitude.
Exactly.
But I just want to say this, that if IRS catches it, that $6,000 contribution will be subject to a 6% excess contribution because you're $6,000 over the amount that you were supposed to put in there.
Got it.
So that also is considered to be a penalty, excess for contributing to the wrong type of IRA.
Okay, so important to follow those rules. Okay, Ed, you round out your first column walking folks through the IRA being a place to receive qualified money from a retirement plan like a 401k or TSP. So why don't you touch on some of the reasons why folks might want to do that?
IRAs tend to be very useful in terms of having access to. Let's take the TSP. TSP this past year did loosen up some of the rules as far as withdrawals are concerned. Like, for example, it used to be that you were allowed to a one-time partial withdrawal from the TSP.
I remember.
Okay. That was it. Once you made your one-time partial withdrawal, either if it's called age-based, you were over 59 and a half, you did it while in federal service, or if you retired from federal service and you made a one-time partial withdrawal, you couldn't do it again. Well, for some people, that was a little restrictive because they didn't want to start taking the money out systematically. They just wanted to leave it there. But just in case they had an emergency, they wanted to take money out of the TSP. If they used up their one-time partial, they could do it again.
Sure.
Well, before the TSP changed that, now you can take, I think it's up to 4 age-based withdrawals. And after you retire from federal service, you can take up to 12 per year after you retire from partial withdrawals.
Sure.
What I would advise people is if they think they're going to need some money from the TSP, and they want to be able to take it out when they needed it, that they should make their one-time transfer, direct transfer of part of their traditional IRA to a traditional IRA, and this way they can take money out of the IRA whenever they want to, because the IRAs have no restrictions as far as withdrawals are concerned. The only words of caution, I would say, is that when someone retires from federal service, when can they start taking money out of their TSP and not be subject to a 10% early withdrawal penalty? 55.
Right.
The TSP, that's the TSP rules. With an IRA, we mentioned a few moments ago, how old do you have to be to take money out of your traditional IRA? You got to be 59 and a half. So that's an important distinction. All right. So that's one reason. Another reason that somebody may want to take part of their TSP and transfer it to an IRA is for investment purposes. Maybe you want to diversify.
Sure.
Yes, the TSP offers 5 funds, 3 stock funds, 2 bond funds. They're the L funds. But maybe somebody wants to maybe diversify some more.
Sure.
They want to buy, for example, real estate funds. They want to buy maybe ETFs. I'm just throwing out some things here, Dan.
Sure.
Okay. Well,
or something is becoming very popular. They may want a socially responsible investment. We get inquiries about those more than ever before.
Absolutely. Absolutely. You can't do that in the TSP, so the IRA allows you to do that. So that'd be maybe one reason.
Sure.
One reason to transfer part of your TSP into an IRA.
Okay. And you round out with some of your thoughts about possible TSP transfers to Roth IRA. And by that, you mean traditional TSP to a Roth IRA. So that is something that could go well or could go badly, right?
I warn people if they're going to transfer their traditional TSP to a Roth IRA to keep the 3-letter word tax in mind.
Yep.
Because when they transfer the traditional TSP to a Roth IRA, that is considered to be a taxable event. I say that because normally when somebody makes a withdrawal from their traditional TSP, the TSP will automatically withhold federal taxes, usually at a rate of 20%.
Mm-hmm.
When they transfer the traditional
I see where this
TSP
is
to
going.
Roth IRA,
Yeah.
there is no taxes withheld. You are responsible for paying the taxes due on that transfer, and it's all taxable. If you are in let's say, a 22% federal tax bracket and you transfer that money to a Roth IRA, let's say it's $10,000, you owe $2,200 worth of federal taxes and then also the state. I also want to caution everybody when they do this, because that transfer is going to be added to your existing income. That transfer could result in your being pushed into a higher federal, in some cases state, marginal tax bracket.
That's not good.
You don't want to, what I call, shoot yourself in the foot when it comes to these transfers. Please work with an experienced accountant who understands tax brackets, the consequences of transferring money from qualified retirement plans like the TSP into a Roth IRA. This is very, very complex stuff, and you don't want to get burnt.
Sure. Don't try it at home, folks. And folks, again, I want to stress, take the time to go back and read Ed's articles too. We're covering a lot of stuff here, but he really gets into some great examples. They're terrific teaching tools. And so to sort of wrap up as we come out of that first article, you talk about benefits of traditional and Roth, but it was really kind of interesting where you even talked about the non-deductible, because that's really counterintuitive. Nobody even thinks that they would want to do that. So the one thing that you really drove home on that is the advantage of the non-deductible traditional IRA is the fact that's one place where income's not really going to be a factor for somebody to be able to use it, correct?
That is correct. No matter what your income level is, you can contribute to a non-deductible traditional IRA. Now, again, until this year, until 2020, you have to be under age 70 to contribute to a non-deductible traditional IRA. Now, the real benefit of the non-deductible traditional IRA is the fact that if somebody really wanted to contribute to a Roth IRA, okay,
I know where you're going here.
But let's say their income is too high. Their income is too high. They're above the limit. They would be allowed, assuming they're under 70, to contribute to a non-deductible traditional IRA and then immediately turn around and convert that non-deductible traditional IRA to a Roth IRA. And if they do it right away, they do the conversion right away. I say right away, there's no earnings in that non-deductible traditional IRA that have not been taxed. They will not have to pay any federal or state tax on that conversion. That is called, in the jargon of the Roth IRA world, the backdoor Roth IRA.
Now, there's some ways people can get tripped up on that, and you have some warnings in your article as well, which we'll get to with the story of William. Now, by the way, when I'm saying this over the air, these are not real people. It just plucks names out of the air. I already told him, if you ever want to be safe, just say everybody who makes a mistake is Dan. My wife would agree with you. So you can put me in there. So we have some examples here that we're going to talk through. We'll be getting to the backdoor Roth on that. But with or without that, you would still have the tax deferred growth on the money, but we have to report we made the contribution on that form 8606.
And then when you pull the money out of that non-deductible IRA, you got to use the form 8606. And when you do a conversion of a deductible of a traditional IRA to a Roth IRA, you have to report the conversion on form 8606.
8606. Okay. All right. So one of the things that you did touch on in the end of your second article, you talked about the case study on Julie, who's young, works for the federal government. She was making about $69,000, and she was contributing to an outside IRA. But because she was also in TSP, she actually had a nice surprise. Why don't you talk a little bit about that?
Okay, so Julie, she works for the federal government, as you mentioned. She's actually 35. She's single. Okay. She discovered this month in January, she got all her W-2s, she got her 1099. She found out that her modified adjusted gross income, essentially her adjusted gross income, is $69,000. Now, as I mentioned earlier, there are limitations for contributing to deductible traditional IRAs. Okay. And for a single person for 2019 who's covered by a pension plan, which Julie is, if the adjusted gross income is modified adjusted gross income is over $74,000, that person cannot contribute to a deductible traditional IRAs.
Mm-hmm.
If they're below 64,000, they can. So Julie is actually right in the middle, 69,000.
Okay.
Okay. So that means that Julie can deduct half of her contribution, which was 6,000, to the IRA.
Okay.
Because she's right in the middle. The IRS has what's called worksheets for IRA dealing. In their publication 590-A, they have worksheets to determine how much of your contribution is deductible if you're in between. They call it the phase-out zone. Okay, phase-out zone. So in her case, she's right in the middle. I made this as simple as possible. So she could contribute $3,000 of the $6,000. $3,000 will be deductible, and the other $3,000 will be non-deductible. So on her 2019 tax return, she'll report the $3,000 deductible contribution as an adjustment to income.
Mm-hmm.
It's on Form 1040. I believe it's as Schedule 1, line 18B, something like that. You'll see it on your.
I feel there's an 8606 coming here.
Okay. But Julie also has to report the $3,000 non-deductible contribution on what form, Dan?
8606?
8606.
I'm getting good at this.
8606. Okay. Again, this is an important month, Dan, January, because we're getting all our income documents here,
Absolutely.
all income documents, and now you can determine what's called your modified adjusted gross income. And the columns I wrote explain what modified adjusted gross income is.
Those tables and charts are in there, and they're great, folks. They're easy to understand. They're easy to follow. Let's talk a little bit about your second cautionary tale here, because I let into it a little bit. And this is poor William, who took a swing at doing a backdoor Roth, and he missed a couple of the rules. So why don't you talk about what?
Okay, so we have a fellow named William here. Okay.
Not an actual person.
Okay, not an actual person. Okay. William has a rollover. It's called a rollover traditional IRA. Apparently, what happened was William worked in private industry, and William had a 401k plan. He left his company, decided he doesn't want to leave the money in the 401k plan.
Gotcha.
So he's going to do a direct transfer of that $45,000 is what it's called.
Trustee to trustee. Yep.
Doesn't come to William first. It goes from the 401k trustee.
No taxes, no penalties.
No withhold, no 20% withholding into what's called a rollover. This is not a contributory IRA. This is a rollover, which is capturing money from a plan. Okay. William makes a $5,000 non-deductible IRA contribution.
Okay. Got it.
Okay. And he decides he wants to convert the $5,000 right away to a Roth IRA.
So to kind of set the table here, William worked in private sector, and let's say now he's employed as a Fed. He's contributing to TSP. He rolled his 401k out. He's got it sitting in a rollover IRA, and he only listened to part of this. He didn't listen to all Ed's good guidance. And he goes, hey, that backdoor Roth, that's awesome. I'm going to do that. Did not get help. Remember, folks said, don't try this at home. So he puts $5,000 into a non-deductible IRA, and then bam, he converts it. And he's so happy with himself until he finds out what, Ed?
He found out that of the $5,000, $4,500 is taxable. Now, why is that? Why is that? Because the IRS does not let you what is called cherry pick your IRAs as far as converting.
Yep.
They're looking at all of them. They're looking at all your IRAs in order to establish a basis. When we look at the $5,000 contribution that William made to his non-deductible IRA, yes, he reported on Form 8606, okay? They're also looking at the $45,000 rollover IRA that has never been taxed.
Yep.
So his total amount in IRA, his total IRA account balance is $45,000 plus $5,000, which is $50,000.
Yep.
What is his basis, so to speak? His basis.
$5,000 out of 50.
So, which is 10%. So the IRS says of the $5,000 that you're going to convert, only 10% is going to be non-taxable. The other 90%, which is $4,500, is taxable. You would know this when you do the calculation on what form?
8606.
That's for conversion.
So 8606 can keep you out of trouble too.
Again, can be very, very, very complex, and you should only use an experienced accountant to do this type of thing.
Do not try this at home. Okay, so let's roll right into Article 4, where you're talking about recharacterizations of IRA contributions. So for starters, it's kind of safe to assume that there was an oops here. And it might not mean that somebody was trying to make a mistake, but maybe they didn't realize how much money they had coming in, weren't keeping track. But so here we are. We've made our contribution into the wrong type of IRA. And the most common reason is due to adjusted gross income, correct?
Here it is, January, Dan, and you put the full $6,000, $7,000 into a Roth IRA. You add up all your income. Whoops, I'm over the limit for contributing to a Roth IRA. Okay. Mm-hmm. If I don't do something, I'm going to get penalized. There's that 6% penalty. That's considered to be an excess contribution. Gotcha. Is there anything I can do to undo that Roth IRA contribution? And the answer is yes. It's called a recharacterization.
Okay.
You can recharacterize the contribution. In this case, it would be to a non-deductible traditional IRA.
Okay.
Assuming the person is under 70 and a half this year, is under 70 and a half in 2019.
Mm-hmm.
The person can recharacterize that contribution. And if it's done properly, there'll be no tax consequences.
Okay.
So that the IRS says, we'll make believe that you never made the Roth IRA contribution. It was always made to the non-deductible, always forgotten. There's no penalty. There's no tax consequences, but it has to be done before you file your taxes. Your taxes. Now, in this case here, if you file for an extension, they will allow you to do it up to the extension.
Okay,
recharacterization. I do want to point out that recharacterizations have been around for years.
Mm-hmm.
It used to be when you converted a traditional IRA to a Roth IRA, and then you got cold feet because of the tax consequences, you could undo the conversion through recharacterization.
Right.
But under the new tax law, current tax law, the Tax Cuts and Jobs Act of 2017, you cannot recharacterize a conversion of a traditional IRA to a Roth IRA. That is out. But you still can recharacterize a traditional, or for that matter, a traditional IRA contribution. Contributions can still be recharacterized.
Gotcha. So again, folks, please make sure you have access to a professional who's well-versed in the nuance of your federal benefits, planning concepts. Make sure you're working with a good accountant when you're trying some of these more complex things. Correct, Ed?
I can't agree more with you, Dan.
Okay. Well, Ed, you've done it again. You took a huge topic, gave our feds a good framework, knowledge to help them make the best decisions here. Folks, be sure to take time to read these articles because he really breaks it down. The stories are great. The graphs are easy to follow. The charts are easy to follow. And it's really going to help you. So, I really appreciate you, Ed, coming in again, helping all our feds. Folks, that's a wrap. We are serving those who serve. Be sure to subscribe to this podcast on our YouTube channel. And remember to share it with feds. Yes, feds, friends and strangers. Check us out on Twitter and LinkedIn. Don't forget our seminars every month around the DMV featuring the guru, Ed Zurndorfer. He was just downstairs at the national headquarters here of Serving Those Who Serve. Had 22 awesome people in there. They learned a ton. Ed Lives, an experience you don't want to miss. For information, go to stwserve.com and click Seminars and Events. I used to say be sure to read Ed every month in the Fed Zone, but now it's every week in the Fed Zone. That's at blog.stwserve.com. Going to give a couple of shout outs here. I want to shout out to my friends Nikki and Jackie at the Furloughs Cheesecake. If you saw my podcast on them, you know how I feel about them. I hope you all having a great year and hope you had a great holiday season with the cheesecakes. And folks, if you have not had a furlough cheesecake yet, you are missing out. I don't get a dime for plugging that. It's just an awesome cheesecake. Also want to shout out to some names that you're going to become familiar with. To Chris Mirabelli. You're going to hear about his story coming up. He is an aspiring Olympian. We are blessed to be able to support him in his quest. Just an incredible young man, incredible overcomer in some of the things that he's gone through. Another shout out to a very dear friend. You will hear from her this year. Her name is Stephanie Brown Trafton. In 2008, she became the first American woman in over 70 years to win a gold medal in the discus throw for the U.S. Super lady. She is going to insult me. I'm just letting you know that. I've known her for years. She's going to give me a hard time. So they're going to be coming up. And also, Senator Rubio, please leave the TSP alone. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your FedLife. Please make it a great one because you deserve it. And remember, Form 8606, we are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.